Guys, these are 5 stocks that super investors are buying right now based on their most recent 13F quarterly filings. Let's check it out. Very first one, Howard Marks bought BABA. Now, guys, we talk about BABA a lot. Howard Marks is a guy I respect immensely. I was actually surprised to hear that he bought some stocks because he's usually a debt guy, but he started a new position on Alibaba. Guys, a lot of super investors are doing that. They look at the China thing and probably think there's a disconnect between value and price. It's our thesis on BABA. But again, just because we or some super investor has a stock does not mean that you should buy it. In fact, on the next investor, you're going to be surprised about one of the stocks they've bought. I was surprised myself, and I still don't agree. Michael Burry is the number 2 investor. He actually increased his BABA holding. Mo, remember when he started buying BABA, we were like, oh, well, that felt good to me. And I'm not saying, I'm not a cloner. I don't sit there and look at an investor and say, oh, they bought this. In fact, there's a small company that we can't discuss that Dalton, our in-house analyst, found for us that we also found that Burry had bought recently. So I was kind of like, oh, that's interesting that they thought alike on that one. But Burry increased his BABA holdings by 50%.
It's crazy. But the fear is there. The price has been beat up again. Why wouldn't you if you still believe in it?
And that fear, Mo, is China. The fear is just a general fear about China. Like, are they going to go to war? Are they communists? Are they doing all these things? Right, Mo?
Going back to Marx, I mean, he's big on debt, and he's looking for those disconnects in things where he can make money. He almost look at this, the fear, and say, this is just a disconnect. It's a temporary disconnect for Alibaba.
Absolutely. Now, the third company was also a Burry acquisition. He started a position in Amazon. Now, that's the one. Yes, exactly. That's the one that I was like, oh, okay. So in previous videos on Amazon, I've talked about how so many Amazon bulls. Well, first off, 95% of Amazon bulls are just bulls because the stock has gone up, right? There's a small select 5% who just have an understanding of Amazon's numbers to a level that I don't. They look at the gross margin and say that is not an accurate gross margin. We've done the videos. They look at the profit margins. Let me pull up Amazon here to show you what I mean in our software. So if you look right here,
that real quick,
yeah, go ahead.
Not a lot has changed since when Amazon was like $95 a share. That's the interesting thing to see him participating now versus just a year ago.
Yeah, I think the fundamentals are pretty much the same. I get what you're saying, and that's why I'm confused. But look at the profit margin here. The gross margin of 16%, 5% profit margin. It is getting better, but this is the thing I've gotten. It's been hard for me to get around because AWS is like 90% margin, and still overall they're at 16%. But this is why, if I don't get the numbers, and if you don't understand something about a company, avoid it. It's okay to avoid companies. Right, Mo? We do it all the time. Yeah, Mo and I will talk about a company. Mo bought a company, and I've bought companies that we both don't reciprocate on. I'm like, listen, I don't get that one. I'm out.
Yeah, exactly. There's no harm in that.
No harm in that. Guys, Jeremy Grantham is an investor I very much respect. If you like talking about markets, if you like reading about markets, I would suggest you read the things he has to say because he's very eloquent. He's very smart. And like all other value investors, he's looked very dumb for the last few years. He increased his position on Coca-Cola. Now, Coca-Cola is another company that I look at and say, it just seems a little pricey. Now, I don't know his goal for this. His goal might be very, very long-term and say, listen, I'm going to be like Buffett. I'm going to buy it. I'm going to hold it for a very long period of time. And Coke is not going away. In fact, Coke just recently reported, they said, hey, proof is costs went up and people still drank an F ton of Coke, which is awesome.
It is insane.
Right? Now, guys, after our next one, I have a little bit of a surprise for you on these investors and what makes them very consistent with each other. So back to Coke here. I believe he has a huge stake in Coke, like $500 million, Mo. So you look at this and you say 2.4% dividend on $500 million. He's collecting $12.5 million a year. Is that right? Yeah, $12.5 million a year in dividends alone. Now, Coke has some great attributes. 22 PE, which is actually way lower. It's 30% lower than when Buffett started to buy them in 1987. I believe he paid a 30 PE for Coca-Cola back then. But you have very consistent free cash flow to earnings. Oh, look at this. Net free cash flow 11.84, net income 11.83. How close is that, right?
Yeah, right on.
Yeah, so you have a great gross margin. It's a company I want to own. It's been flat for over 10 years. Not flat, But over 10 years, it hasn't done bad. It's done about 7% a year plus dividends. Being up 100% over 10 years, that's about what that is, right? 7% a year, you double in 10 years, plus you have dividends. Not bad. Not bad at all. And it's a company that I might be adding to my list of must-owns forever, but I'll keep you posted on that one. Guys, the fourth super investor and the fifth stock, JetBlue, Carl Icahn. Carl Icahn bought a 10% stake in JetBlue. If you remember, it fell precipitously after the acquisition of Spirit fell through. Big fiasco. Carl Icahn clearly saw some value there, and he jumped in all in on it. So let's see if we can see what he sees in JetBlue Airways. So Carl Icahn tends to be an activist investor, right? He wants to go in, get a board seat, enact some changes, and guess what? That's what you have to do when your profit margins are negative, when your free cash flow is negative, when you're having issues like this. For me, it would be going to Uber and saying, stop buying back shares. Don't announce this share buyback, which they just did. It'd be me going to a company that pays a lot of dividend, that's selling cheap, and say, stop paying your dividend, buy back shares. Carl Icahn sees some sort of value there and wants to extract that value out of the company. And he's great at doing that, so we wish him a lot of luck. But guys, before I show you the consistency that these investors have, let's analyze Bob and Amazon and show you guys how we agree and also are confused by these. So let's pull up BABA real quick. All right, guys, so we did this BABA analysis a while ago. We did 3, 6, and 9% revenue growth on a 10-year assumption analysis. We did 15, 19, and 23% profit margin, and the free cash flow is actually higher. If you look at their financials, look at these financials, much higher free cash flow. So I put in a higher free cash flow assumption. I did a PE 10 years out of 16, 18, and 20. Same with price of free cash flow. Now for me, I put in 9% desired return, no margin of safety. This is what I basically consider the company to be worth on the market. Mo, what do you think about that? Like, I want people to be able to decide what their margin of safety is. Because if somebody has immense knowledge in China, they might sit there and say, I don't need a huge margin of safety.
Right. Or if somebody's scared to death of owning in China, but kind of wants to own it because it's such a discount, maybe you go in and you put some crazy margin of safety and say, man, I have a 20%, 25% return in there and I still am green. Yeah. Maybe you go after it. Maybe you throw some money at it. So, speaking of which, let's hit the analyze button. Guys, this is why we're interested in this. The stock's at 73 and we have a low price of 120 to 140, high price of 340 to 400, middle price of 200 to 240. To Mo's point, if our middle assumptions occur, we think the stock can generate 28% returns a year for the next 10 years based on buying at today's price. Again, this does not mean you go out and buy it. No. For us, it just says we understand why Howard Marks and Michael Burry both either entered or increased their BABA position. Now, for Michael Burry, let's pull up Amazon, because this is the one that I honestly just don't get, and I'm okay not understanding it. You got to understand, like, the world in which I live in that I want you to join us with is this world of saying, all right, I don't get it. I'm moving on to the next opportunity. I'm okay not getting something and just moving on. Yeah, I don't have that FOMO, right, Mo? Mm-hmm. I'd rather just use Amazon every day and not own the company.
Yeah. And I will do great using Amazon every single day. But the assumptions I made were 4, 7, and 10% revenue growth. I did profit margin of 4, 7, and 10 as well as free cash flow. Well, let's be aggressive. Okay. Let's sit there and say, let's call it 7, 12, and 17%. Wow. Guys, keep in mind, they've never done this. And this is my concern. But to the point for people who are Amazon bulls who actually have analysis on it, they sit there and say, listen, there's a lot of pent-up profit in there that hasn't been properly experienced and seen. So let's put some higher margins in here. Remember, their gross margin was 16%. Gross margin is before paying all overhead costs, all taxes, all interest. I'm giving them 7, 12, and 17. And for PE, I did 17, 21, and 25. Same with price of free cash flow. And I did a 9% no margin of safety return. Hit the analyze button. The stock's currently at 170. I still think 67 in the low, 340 in the high, 167 in the middle. So unless you're thinking that the high end is what makes the most sense, you're probably like me saying, I don't know if I understand this, right? And it got low. And it got low, Mo. I mean, what's the low in the last few years was $81. Yeah, $81.69 was the low in December of 2022. Oh, wow. The 52-week low is 88. Yeah. So, guys, it could be a buy at that point. I'm okay just saying, I don't get it. I'm going to have to assume that they're so big that I have to assume their future. They've already, how do they keep spending to mask the profit? I don't know. But Burry is a brilliant investor. He analyzes companies very well. And so he sees something that I don't. But guys, here's the thing I wanted to show you about these super investors. The consistent thing about value investors is amongst them, they're inconsistent. Guys, they have a thesis, and we've always talked about this. Value investing is a way of thinking of the world, but the way in which you determine the future cash flows of every investment is going to be wildly different than everybody. Guys, here are 5 value investors that we love. Michael Burry, Warren Buffett, Li Lu, considered the Warren Buffett of Asia, and Munger's guy, Monish Prabrai, who we've interviewed, a friend of the channel, and Guy Spear, a friend of the channel, and look how different they are. I mean, there are some consistencies here, but more or less, are there consistencies? Bank of America, Bank of America.
I see American Express twice.
American Express, Citigroup. American Express right here.
Class B shares.
Okay, Berkshire Hathaway, Alphabet is 1. But these are very across the board here. I mean, oh yeah, Bank of America is owned by Guy Spear as well. So I look at this saying, guys, these are 5 incredible investors. There'll be times when an investor we love sold a company that Burry recently increased his stake in. Last quarter, our guy sold it, Burry bought it. It's like they're both value investors, but that's the point of investing. It's all about the way in which you view it. And we also don't know their time frames as well. Does Michael Burry have a different time frame than the investor friend of ours who sold? These are all the things. That's why we always tell people, don't just buy something because somebody you respect owns it. It should be a way to say, oh, that's interesting. I never thought of it that way. Let me go look into this because I never would have thought this person would have bought it. And just because they hold it doesn't mean they think it's a good value today. That's the other big thing, especially a guy like Warren Buffett. His goal is to own all of these for a very, very long time. He doesn't necessarily add to these positions all the time. He might just be holding this. So don't get confused when you see their holdings and say, oh, they have this, I must buy it. No, they bought it at a different time, different place, and their basis may be so low, or so they just don't want to sell it right now. So guys, if you want to see what 30 companies I like that I want to own forever, check out our next video. Thank you for your time.